Good morning, guys. Welcome to the Black Forex Academy channel. If you're new to the channel, be sure to subscribe so that you won't miss on the future content that we'll be producing. It's a weekend. I hope you had a lovely week. I hope you had a fantastic trading week. Right now it's the weekend, so it's time to reflect, to analyze, reanalyze the market, for the coming week, and possibly correct a few mistakes if we made any in the previous trading week, right? So today I'd like to talk about a special pattern which I think is most relevant in the current trading situations because we're just coming out of December, right? December is actually a low trading month. So I think from a low trading month where there's lack of volatility in the market, lack of volume in the market, and coming now to January where there's an increase, there's a huge surge in the market, a huge volume in the market right now. I believe it's time that you can actually know how to trade off the low season into the high season, right? Also, like since last year was also affected mostly by the the coronavirus, and in some countries it's still out there. So it's actually most of the currency pairs don't trend that much, but mostly consolidate, right? So I'd like to share with you a pattern today that will actually be of much use and much help in how you can be trading these market scenarios out there. So without further ado, the pattern that we're going to be learning today is the ascending channel pattern. Okay. I think an ascending channel pattern, for those that are not familiar with it, it's a pattern in which prices consolidate or bounce off two price levels in an ascending direction, right? So let's say we have price level A here, like this ascending trend line, and then we have price level B here. This also represented by the ascending trend line, the bottom one. Now, an ascending channel, prices would only be bouncing off in between these two zones here, right? They can be trend lines, they can be zones, whatever you want to call them. Because actually trend lines are also just diagonal support and resistance. And support and resistance aren't actually lines, but zones. So yeah. So an ascending channel is actually just when prices actually are just bouncing in between these two price ranges until they finally decide to break out in either direction, either up there or down here, right? So in the low seasons or in the like last year, most of the patterns, most of the charts were actually producing these consolidations where people were seeing prices just bounce off in between zones, like very high consolidation ranges from the lower time frames to the higher time frames. There were a lot of consolidations. Now, these consolidations are actually indecisions in the market due to low volatility, low liquidity. That's why the market doesn't have enough volume to actually move in a specific direction. So they're just interchanging between buyers and sellers. So here you can see the sellers and control, the buyers and control, the sellers and control, the buyers and control. Nobody is in definite control of this pattern or the chart, pair, whatever, right? It can be a stock too because this is a price action pattern. So whatever you're trading, this pattern is relevant. So just stick with me, okay? Now, this pattern can actually be very helpful in how to trade out of a consolidation market, out of a consolidating market. Because if prices are consolidating, it would be dumb to actually trade while prices are still consolidating. But after the breakout, then it's actually wise to actually know, because if you see prices maybe break out below here, retest maybe, and then keep pushing lower, then you'd understand, okay, the sellers just took over this thing, right? And for example, if prices broke above here and then kept on pushing higher, then you'd actually understand, wow, the buyers are in control. So you can actually swim with the big sharks, as we like to say it. You want to swim with where the money is. You want to swim with the big sharks. You don't want to be left behind. You want to flow with the money, right? Now, this pattern, how to trade it, right? The ascending channel. So an ascending channel, first of all, as I just said before, it's a pattern. Oh shit, excuse me. It's a pattern in which prices are consolidating in between two price ranges, but also while still moving in an ascending direction. So they're consolidating between these two zones, but then they're also, moving in an ascending direction. Now, I got this question a lot from the students that I mentored and all that, like, isn't prices moving, like, aren't the bulls in control, right? The truth is, not, they're in control, like, in the long run, but not most definitely, like, they're not in total control, right? Because for a price to be, to say, like, say, the bulls or the bears in control, you want to see a trending market, not a ranging market. This is a ranging market. So the bulls, like in this particular case scenario, might have an edge over the bears, but they're not in total control. So they have an edge, but they're not in total control. That's the difference, right? Now, in this particular market scenario, what you want to do is wait for a breakout, okay? In either direction. It can't be clear until the breakout has actually occurred. So in either direction, after seeing these two price ranges that the market are having trouble breaking, what you want to do is wait for a breakout. Now let's say the market actually breaks above here, retests, and then pushes higher, right? Now what you want to do is actually wait for the breakout, right, out of this zone. Let me make it a little bit better, like that, maybe. Now, after this breakout, you want to see the market, depending on the type of trader you are, right, of course, after the breakout, then you'd be looking for an entry because you'd know who is now in control of this pair. Now, for instance, if the bulls break out here, for those breakout traders, of course, you'd be taking your trades here. Now, for those conservative traders, which I happen to be part of, you'd wait for the retest to look for entries to actually take your trade, right? Now, after the breakout, how do you actually know where the market is heading, or where do you place your targets, where do you put your stop losses and all that, right? Now, if prices were ranging like this, so first of all, your stop loss would have to be just below this zone here. If it was a zone, if it was a trend line, whatever. For conservative traders, this is where you're placing your stop loss, below this zone here, below this channel, below this trend line, whatever, right? Your entry, of course, would be somewhere here for both aggressive and no, for both breakout and retest traders, because the confirmation candlestick would actually close above here. For the breakout, would be here. For the retest traders, would be around here. After this, the market starts pushing back up. That's when you take the trade, right? So here's where you'll be putting a stop loss, of course. So it's actually diagonal. So I'm gonna lay it down like this. Here's where you'll be placing a stop loss. And then here is where you'll be placing your entry, right? Right here. And then after that, what you want to do is actually measure the distance of this channel, like from the top trend line zone or to the bottom trend line or zone, whatever, depending on the type of trade that you're in or pattern that you trade. Now, the distance from up here to down here should be the same distance from the breakout or the retest, how you're trading, depending on yourself, to where your take profit should be. Do you get that? So the distance from the top trend line to the bottom trend line has to be the same distance from the retest to where your take profit should be. So in other words, that distance there is where you place your take profit here. After measuring the distance, that is where you'll be placing your take profit. Right there. So as you can see, the market was consolidating, then you saw a breakout, a retest, and then you took the trade. Your stop loss should be just below here, your entry there, and your take profit should be the same distance from the top line to the bottom line. Okay, now with this type of scenario, with this type of theory, let's move right into see how you can actually apply this knowledge in real-time charts and see how you can actually look for potential trades. Now, before we actually move there, this type of pattern actually provides good actually from anywhere from 1:2 to anywhere to 1:3 trades. So but anyway, let's look into the charts and see how we can actually, if we can actually spot a channel. I believe that it will be easy to spot. As usual, I'm using the daily. The daily is actually much more easier for me, so you should actually work with what works with you to spot channels. So as you can see here, perhaps maybe we have some sort of channel here. Okay. That's not a, it's a channel, but it's not that. It has only 2 touches. Okay, 1, 2, 3, 1, 2, 3, breakout, right? Retest here. It's not the potential channel, because with a channel, what you want to do to trade a channel, you want to know that the top line and the bottom line are parallel to each other, right? They have to be parallel, but as you can see, these ones are actually diverging from each other, right? And that's not a good pattern to trade. These ones are also called, so I'll be teaching them in the coming channels. I hope you'll be patterns. I hope you'll be together. You also have some are called ending diagonals, where they're actually converging, right? Now there are 2 types of ending diagonals. There are converging diagonals, and there are the ones that aren't converging. So like this one was an example of it. So you can actually see that doesn't. Okay, I don't think out here we'll find any. I'm thinking let's try and change the chart and see if we can actually spot any. So this is GBP card. Let's see if we can actually change, maybe move to another price chart. Hold on. Before we actually move, I think I just spotted one right here. Let's see if it's actually valid here. Yep, we got one. We got one. Right. So this is a perfect example of an ascending channel, right? Prices have been ranging between this top price and this bottom price, right? You couldn't tell who's in control, right? You could trade in the lower time frames because this is actually the daily time frame, right? But if it was the lower time frames, it would have been hard for you to trade, right? Now, given this particular scenario right now, depending on the type of trader you are, right, would have shown you where you're actually going to take your entries. Now let's see how we can actually apply them. Now, as you can see here, this is where the breakout occurred, right? And then market pushes down here, retests, as I told you, and then pushes down here. Now for the breakout traders, this is where you're placing your entries, right here, right? Because this is where the candlestick actually closed. And then you'd be looking for trades to scale all the way down here to your take profits. For the retest, as you can see here, prices touched here, and then started with a very high volume. So you can't get an entry here from the daily, of course, as you can see the candles, the way this is a bearish engulfing. but I think it's way too advanced. So what you're going to do is actually go to the 4 hours, go into the lower time frames, and then look for entries. Now, after the retest here, this is where you'll be placing your entry. After this bearish engulfing, this would have been your confirmation candlestick, right? And for the breakout, if you want to go in lower time frames, this would have been your confirmation candlestick. Now, let's go back first to the daily time frame and see where prices would have actually advanced, right? As I told you, at this pattern, what you do is you actually measure the distance from the peak to the lowest point, like the distance from the high trend line to the low trend line. And I'm actually doing this because you can see they're parallel to each other, right? Now, I'm going to take this line, put it here. After the retest, the distance from here has to be the same distance to the take profit. And as you can see, wow, look at this. It's amazing, these patterns, the way they work. It's actually meeting here down here. It actually aligns with this support zone. So you can see how price action is actually very good at these things, right? Now, after the retest, your take profit should be at this zone here. Now, moving down to the 4 hours to actually see how we would have taken the trades. Now, for the breakout traders, you would have taken the trade here, right? This would have been your entry. Your take profit would have been down here, and your stop loss would have been just above that candlestick, right? Providing a 1:4 risk to reward. That's a nice trade. Obviously, take profit was hit around here. And for the retest traders, we would have taken the trade here after the retest. Providing us with the, yeah. Where's that line again? Okay, let me just measure another one. So after the retest, all the way down here. So it will have been around here, 2.5. Now, as you can see here, that's another difference between the breakout and the retest traders. For the breakout, they had a 4:2. The retest, we had a 2.5. All is good, all is well. If you remember the last pattern, these ones, the breakout traders, as I told you, they have an advantage because they have a bigger win risk to reward ratio, but it's risk trading because they get stopped out most of the time. If you remember in the head and shoulder pattern, the breakout traders were actually stopped out of a trade in which it gave us a 1:3 risk to reward. Now, depending on who you are, the type of trading you do would depend on how you want to trade this. If you're okay to lose money most oftenly but make more money when you make, then breakout strategies for you. But if you want to be safe and make money most of the time, consistently, the break and retest is for you because it provides with smaller risk to rewards, but many of them. These ones, the breakout trading, it gives you fewer wins, but higher wins, right? So that's how you actually trade an ascending channel. As you can see here, from the daily perspective, we would have gotten nice, good 2 trades. No, 1 trade, depending on the type of trader you, of course, and which would have turned out to be amazing winners. So I hope this video has been of value to you. Till next time, guys, this is your honest coach, Black speaking. Don't forget to hit the like button and don't forget to subscribe so that you won't miss on the future content. Without further ado, I hope you have a lovely weekend. Peace.